Hi, everyone. I've started to read some of the reflection posts that are already coming in. Plus, I've received a few emails, and students have indicated, varying degrees of difficulty with some of the homework. I think by and large, most of you are doing a really good job. I think there's just a few areas that some folks are going to struggle with. So I want to try to help as much as possible. Again, the more specific you can be with your feedback in terms of what exactly are you struggling with, the better I can prepare to kind of help you. So what I'm going to focus on right now is I'm going to focus on a couple of things, just a few things. One, the nature of accounting as far as the accounting equation is concerned, but more in an applied fashion. And then I want to talk about transaction analysis and the use of that table structure, that spreadsheet structure that you might or might not find difficult or daunting. So first, the relational nature of accounting. Remember that our base equation for accounting is assets equals liabilities plus equity. These, each one of these, 1, 2, and 3, are considered elements. Okay, they're defined in the accounting literature. They're specifically called elements. They're defined in the accounting literature. What you tend to work with is the accounts that are underneath them. So underneath each one of these are going to be different accounts. So within each element, there's a series of accounts. And in an actual accounting system, there'll be a numerical value placed or assigned to each one of those accounts because that's the way systems work. So an example of an account would be cash or accounts receivable or short-term investments, inventory. And these would be considered what we would call current assets. Okay. There could be others. In addition, we could have plant, property, and equipment. And this would be a non-current. A non-current, yeah, let me see that. There we go. A non-current asset, okay? So each one of these elements is made up of different accounts. The primary account you'll deal with in liabilities, and I'm going to draw a little line over here, is going to be payables. And they tend to be current in nature. They're a current liability. Other things that are long-term would be bonds. And we'll get into accounting for bonds later, but these would be your what we call the long-term liabilities. Okay. For equity, put a line here, the types of accounts, you're going to have capital accounts, which include things like common stock. Okay. The other thing you will see inside of equity is revenue and expenses. But how they show up is interesting. In the transaction analysis, we look at them as revenues and expenses. The net of these, when you net these together, is net income. Net income. Now, what we call this, I'm going to have to, I've run out of room here on my desk. I have a nice desk at home, but I still, with all the stuff I have, I still run out of room. So the revenues, expenses, net income, the account you'll see at some point, okay, and you just have to kind of follow my arrows here. Whoops, there we go. Is called retained earnings. Okay, so, and that's because things in the balance sheet, these accounts here, okay, revenues and expenses, these are what we call temporary accounts. That means they recycle every financial period or every fiscal period. Okay. The balance sheet accounts, cash, accounts receivable, inventory, plant, property, and equipment, common stock, payables, bonds, these do not recycle every year. They continue with the business. So they don't ever zero out. Whereas revenues and expenses, we zero those out every year and we close them. What we do is we go through a closing process to move the result, which is net income or net loss, to this account here called retained earnings. That's where it all goes. And we'll learn about this when we talk about the accounting cycle. So the upshot is it's all relational. So when you're looking at a transaction analysis problem, and I want to go pull a sheet of paper here. All right. When we look at a transaction analysis problem, essentially what you're looking at the accounting equation here. You've got assets, liabilities, and equity. You've got your cash, accounts receivable, and office equipment. So you have your elements, assets, liabilities, equity. And then underneath that, you have the accounts, cash, accounts receivable, and office equipment. Over here, accounts payable, or what they call trade payables. And then over here under equity, you've got your capital account, common stock. You've got dividends, which I'll talk about in a minute. And then you've got revenues minus expenses. And so it's plus revenues minus expenses. The net of those two is net income. And again, what happens is this every year the business will generate either net income or net loss. And the sum of that is what makes up retained earnings. So every year 1, year 2, year 3, there's net income or net loss, every year. That result gets closed out to this account called retained earnings. And we'll see how that works in a little bit. So I'm jumping ahead a little bit on that, but I just want you to understand what the purpose of having revenue and expenses under the equity section, because this here represents the income statement. Okay, this represents the balance sheet, and then you've got the statement of cash flows embedded in here as well. Okay, so let me go back to my other sheet of paper. So when we look at it from a transaction analysis, when you hear the term transaction analysis method, that's the kind of stretched out, that is the kind of spreadsheet or table view, okay, where they solve the problem, and then what the problem will end up looking like when you work through it is something like this. Okay, where you'll have a list of transactions, and you'll have to go through and analyze each transaction, figure out what accounts are involved with each transaction, and then each row is a separate transaction. Okay, and so you'll just go through, and that's how you kind of proceed through, and periodically you'll strike a balance. So you'll see there's a balance line there, there's a balance line there, because they're keeping tabs of what the total cash is, what's total of accounts receivable, because again, these are accounts, these are specific accounts where activity is recorded. Okay, they're classified, and that's where we get the term classified balance sheet. They're classified by elements, assets, liabilities, and equity. And they also classify them by time, meaning current or non-current if it's assets, current or long-term if it's liabilities. And then they're also classified by liquidity. And liquidity just means how close is it to cash. So cash gets listed first because it's the most liquid of the assets. Accounts receivable is typically second because it's something that you plan to collect. And so it's going to turn into cash quicker than anything else will. Inventory is also in there. Inventory has to be sold first. See, accounts receivable just needs to be collected. Inventory needs to be sold and subsequently collected. So it's a step removed. Each movement away from cash means that particular asset is less liquid. Okay, same thing on the liability side. Liquidity is really the deal there is how quickly will you have to give up cash? And so accounts payable or the different types of current payables, those are going to be the ones that are going to be due first. Okay, the long-term liabilities, bonds and long-term loans or notes as we refer to them, those are more future oriented, and so those we will pay off in longer periods of time, so they're less liquid. Okay, and so they get ordered from current to long-term, and then from within the current, they'll generally just order them. You know, you could do it anyway. A lot of times it's accounts payable that starts out first, and these are called trade payables as well. These are the payables we owe our vendors. There could be wages payable, salaries payable, rent payable, any number of types of payables you can set up. Because again, there's no hard and fast rule as to how many accounts you have to have. That's pretty much up to the company to decide that. Company management will make those decisions. But this is the structure of a transaction analysis, okay? The other thing we're going to learn is, how do accountants think about this? And the way accountants think about it is we deal with journal entries. So say, for instance, we have a transaction where I purchase office supplies for cash. Okay, that's one possible transaction. And the way that journal entry would show up, I'd have the date. Okay, I have the date. Then I would have my office supplies is an asset. Okay, it can be office supplies inventory. I'm going to show you one variation here. Office supplies inventory. This is one part of the journal entry. The other part is cash. Notice how I offset them. Okay, that's the way the journal entry would be set up. And then you'd have the dollar amount. Again, offset, it's easier to read. Okay, and so that's one. Here we basically exchanged cash for office supplies inventory. We need the office supplies to say perform whatever services we're going to perform and to keep records of things. And so we purchase office supplies and we use our cash to do that. So we have gone from being more liquid to less liquid, but this is a usable asset that we can use to generate revenues in the future. Okay. The other way you can do this is supplies inventory. The other way that a small business might look at this is they may just say office supplies expense. I wouldn't say this is the preferred way to do it, but it is one way that a company will do it. And I'll explain to you the difference here. In version number one, what we're doing is we're putting office supplies into inventory, okay, which is an asset, and then we're using cash, which is an asset. In the second version, we're basically expensing it as if it was all used up. So we purchased it and we immediately charged it off to expense and then show the credit to cash. That's our cash payment. We hand out cash to whoever we're paying it to, okay? And then we receive the office supplies, okay? In one case, we're putting it into inventory. What'll happen with this preferred method is that as we use the inventory up, we will recognize office supplies expense. And how we'll do that is somebody will actually go and physically take an inventory. They'll count up the office supplies that are left, figure out what the value is of that inventory based on what was paid for it, and make an adjustment to the inventory account. And so they would basically at that point debit office supplies expense and credit office supplies inventory. Okay, so if we were to do version 1A, okay, related to it, at some point at the end of the year, we would have an adjusting entry. We'd take inventory, figure out what we had left, and at that point, go office supplies expense. And debit that account. And then credit office supplies inventory. And so what happens is we've got a certain amount that we put in inventory, and then we have an offsetting amount that we took out of inventory and used up. And so the difference between the debit to office supplies inventory and the credit to office supplies inventory represents what we have left in office supplies inventory. That's why this method here is the preferred method, okay? This method here, this is only used if office supplies are immaterial. They're just not that big a deal. We don't have that much of them. If it's material enough, you really need to do the accounting correctly, which is to debit office supplies inventory and then credit cash. The other option is you can, instead of paying cash for it, you could purchase it on credit or on account. And that would mean that we would, instead of crediting cash, we would credit accounts payable. Okay, and then at some point we would actually pay the cash to the vendor, and so then we would debit accounts payable and credit cash. And that's how these journal entries work. The other part of the record keeping that you're going to see with accounting is something called a T account. Okay, and so we see a T account, and it's for a single account, cash. And notice there are two sides to this. Okay, this side is for what we call debits, and this side is for credits. Okay, a credit, and again, somebody had mentioned the pluses and the minuses, we're getting to them. This is where your debits and your credits come in, and you just have to kind of memorize this part of it. There are some things that you do have to memorize with accounting, and your debits and your credits and what we call a normal balance. So for cash, a normal balance is a debit balance. For something like accounts payable, if I'd set up another account over here and call it accounts payable, okay, then this account here, this is the debit side and this is the credit side, okay, but the normal balance here is a credit. So I'm going to put an N here for normal. That's the normal balance for accounts payable is credit. And over here for cash, the normal balance is a debit. Okay, and you'll see how that plays in when we actually run a trial balance, which is just a listing of all of the accounts for that company with the balance. Okay, so you'll have, let's stick with the cash account here. So cash receipts are going to be showing up as debits in the cash account. Cash payments, or what we call disbursements, those are going to show up as credits. And at the end of the period, you will calculate the balance. And the balance should be a debit balance. You should never have a negative cash balance, right? That makes sense. And so that's what you end up with. That's why we call it a normal balance. Over here in accounts payable, right? When we purchase something on credit, okay, our purchases, okay, that's where they're going to show up here. This is where our purchases are going to show up. When we make a purchase of something and we owe it to somebody, this is where it's going to show up. When we make the payment, when we actually disperse the funds, the payment side would show up here. Okay? And why is that? Because the credit side increases the account balance for accounts payable. So as we purchase more things on account, the balance goes up. As we make payments to our vendors, the balance goes down. Over here, as we receive cash, the balance goes up. As we disperse cash, the balance goes down. The balance here never goes below zero. It should never go below zero. So it should always be a debit balance, a positive debit balance, or zero. Over here in accounts payable, your balance will always be on the credit side. That's where your balance will be. Because if your balance was a debit balance in accounts payable, it would mean you overpaid somebody. So think about it. If I owed $10,000 and I paid $11,000, that would mean I'd have a debit balance of $1,000 in accounts payable. That's not right. We paid too much to somebody. Okay, that's how we identify problems. So an auditor would come along, and one of the things they'll do is they'll scan the trial balance, looking for any strange balances that are not normal. Okay, they look for balances that are not normal. And so the grouping of these accounts, okay, all of these T accounts, this is what's called the general ledger. So the entire collection of T accounts is what we refer to as the general ledger. Back on this side, when we're dealing with these journal entries go into what we call the book of original entry, okay, or what we refer to as the general journal. And all we do there is we just, in date order, chronologically, we record every transaction that comes in date order. Then we do something we call a posting process, where we take these figures here, okay, with their accounts, and then we post them to these T accounts. And that's what the accounting system is doing. Then we can calculate our account balances, which is what facilitates or makes it possible for us to come up with a trial balance. And from there, we generate our financial statements at the end of a financial reporting period. That's kind of the way the accounting system works. And that's why you have to get used to the pluses and the minuses. Some accounts have a normal balance that is a credit balance. Those are your liability accounts. And most of your equity accounts are going to show up here. Over on the asset side, your true assets are going to have a normal debit balance. Okay, they're increased by debits, decreased by credits. Over here, increased by a credit, decreased by a debit. And that always is true. All right, now we'll get into other kinds of accounts, and we'll see other kinds of accounts at play as we advance in our study of accounting. But you have to remember, accounting, it's all about record keeping and about measuring performance. So it's keeping track of stuff and also at the same time recording and reporting performance. So reporting net income is performance, okay? Keeping track of the balance sheet is keeping track of what it is we own and what it is we owe. That's basically a simple way to kind of think about it, okay? So that's going to be the end for this particular recording. The next one I do, I'm going to take a closer look at transaction analysis.